A man sits in his car outside a Payday loan store, staring at a piece of paper he just signed. 300% APR. He knows what that number means. He works in finance, actually. He's explained interest rates to other people for a living. He didn't check the math before signing. He just needed the $400 in his account by morning. To understand how a man who understands interest rates ends up in that parking lot, we have to go backward. Rewind 6 hours. He's at his kitchen table, calm, competent, running through his monthly budget the way he does every week, meticulous, in control. If you'd shown him that loan agreement at this table, he'd have laughed and thrown it in the trash. Rewind further. 2 p.m. A call. His company just announced layoffs, effective immediately. His name is on the list. 20 minutes before that call, he was arguing with a coworker about which project management tool was better. 20 minutes after, he's calculating how many days his checking account will actually last. Same person, same brain. A completely different version of him, and it took 20 minutes to show up. Rewind to what was actually happening inside him during those 20 minutes, because this is where the real story lives. Under acute stress, the body redirects resources toward immediate survival processing. Cortisol rises. The prefrontal cortex, responsible for long-term planning and complex reasoning, becomes measurably less active, while faster, more instinctive decision-making systems take over. This isn't weakness, it's biology. The same biology that once helped humans react to physical danger, now firing off in response to a layoff notice. The problem is that financial decisions made in this state tend to be short-term, reactive, and often worse than decisions made calmly, precisely when the stakes are highest. Rewind to 6 p.m., 4 hours after the call. He's applied to 9 jobs, refreshed his bank app 11 times, and hasn't eaten. His rent is due in 3 days. His savings won't cover it. Calm him. The man from the kitchen table would have called his landlord, checked his emergency options, maybe borrowed from family. But calm him isn't the one driving anymore. Rewind to 9 p.m., the exact moment before he searches fast cash today on his phone. This is the hinge point of the entire story, and it looks like nothing. Just a search bar, a few typed words. Research on financial decision-making under stress shows that individuals facing acute financial pressure are significantly more likely to take on high-interest debt, make impulsive withdrawals, or accept unfavorable loan terms, compared to identical decisions modeled without time pressure. The irony is sharp. The moment someone most needs clear judgment is the exact moment their brain is least equipped to provide it. Now, play it forward. Back to the parking lot, paper in hand, 300% APR sitting quietly in the fine print. He signed it in 9 minutes. Kitchen table him would have taken 9 days. Here's what makes this bigger than one man's bad night. Studies on consumer lending show that predatory loan products, payday loans, high-interest installment credit, are disproportionately used during acute financial stress rather than during stable periods. These products are structured to be signed quickly, with minimal friction, exactly when a borrower's capacity to evaluate long-term cost is lowest. This isn't accidental. Lenders don't need to understand neuroscience to notice which conditions produce the highest approval rates and the least scrutiny. The system doesn't need to target pressure you specifically. It just needs to stay available and frictionless during the exact windows when pressure you is most likely to show up, and sign something calm you would have questioned. Here's the hidden math that could have changed the entire night. Rewind further still. An emergency fund isn't just a pile of money. It's a mechanism for buying back cognitive function. Every month of expenses saved in advance is functionally a delay between the stress event and the moment reactive decision-making has to take over. Someone with 0 savings hits panic mode within days of a lost paycheck. Someone with 6 months saved gets 6 months of calm brain decisions before pressure brain ever has to take the wheel. He had 11 days of savings. 11 days for a job search that statistically averages closer to 5 months. Now compare the hype to the reality. The hype? Discipline is a fixed trait. If you're financially responsible, you'll stay that way no matter what happens. The reality? Discipline is state dependent.
The same person can make excellent decisions calm and poor decisions under acute pressure, and most financial planning completely ignores this variable.
This isn't an argument that people under financial stress are somehow flawed. The distinction that matters is this. The danger isn't having a pressure response system. Everyone has one. The danger is never designing your finances to account for the fact that a worse decision maker will eventually be the one in charge at the exact moment decisions matter most. This is why some of the most financially resilient people aren't the ones with the highest income. They're the ones who built systems in advance, specifically because they assumed a worse version of themselves would eventually be making decisions under conditions they couldn't fully predict. Nobody warns you in advance which day pressure you will show up. There's no calendar entry, no notification. It just arrives, usually at the worst possible moment, wearing your face, signing things calm you never would have signed off on. The real question was never why he signed that paper. It's whether you've built anything in advance that limits what your own pressure self is able to do before the day it shows up in your seat.